home loan of 50 lakh rupees with an interest rate of 8.5 per annum and a tenure of 20 years. At the current rates, your EMI will be 43,391 rupees. Now, what happens to your EMI if RBI cuts the repo rate? Well, for the first time in 5 years, RBI has cut the repo rate from 6.5% to 6.25%. The Monetary Policy Committee of the RBI has announced a 25 basis point cut in the repo rate, bringing it down from 6.5% to 6.25%. With this financial decision, how is the decreased repo rate going to affect home loans, EMIs, and your FDs? Also, how repo rate works? Let's understand in today's episode of Newswatch. First things first, repo rate is an interest rate at which RBI lends money to commercial banks. Also known as repurchase rate, it is set by the Reserve Bank of India. In India, Monetary Policy Committee is in charge of determining the repo rate. So how does it work? When banks need funds, they borrow money from the central bank by offering government securities as collateral. The banks agree to repurchase these securities at a later date for a higher price, which also includes the interest. This is the first time that the RBI has cut rates after 2020. The last rate cut by the Reserve Bank of India was in May 2020 when it had slashed rates by 40 bps. So now with the latest repo rate cut, how will it impact your home loans, EMIs and FDs? The repo rate cut is expected to provide relief to the borrowers with loans, EMIs likely to go down. Banks will react with reduced interest rates on home loans, making them more attractive to borrowers. This repo rate cut will immediately lower the interest rates on most of the home loans. Hence, borrowers get benefits from a repo rate cut. Let's understand it better with an example. Suppose you have a home loan of 50 lakh rupees with an interest rate of 8.5% per annum and a tenure of 20 years. At the current rates, your EMI will be 43,391 rupees. Now, after a 25 bps repo rate cut, the interest rate will reduce to 8.25%, bringing it down to 42,720 rupees. For FD investors, especially senior citizens who rely on interest income, a cut in repo rate means lower returns. If banks reduce rates soon, new FD investors will earn less than those who locked in at earlier higher rates. A lower repo rate can lead to higher inflation as increased money supply and lower interest rates can drive up prices. It can reduce the interest earned on savings, making it less attractive for individuals to save. In conclusion, generally when the repo rate decreases, the cost of borrowing increases, loans become cheaper, there is an increased consumer demand and also high inflation risk. What do you think of this decision by RBI? Let us know in the comment section below and keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.